Welcome in.
Here you are. Folks, we just turned on record because I had a question for Brian and I'm going to hit him cold with it. And you
Oh,
get to see how this goes.
okay.
So, Brian is in his brain a financial trader. That's what he does. That's how he thinks about things when he approaches the market. Comes from financial first, but he is a very good fundamental player as well. So, he usually starting with how do I understand the financials through the fundamentals, and then how do I understand the fundamentals through the financials? If you start as a financial trader, one of the things you always look for is the spike. When something happens fundamentally, you see a spike,
Right.
just like we saw the last couple of days with crude oil. Once we start blowing things up, people spike, it goes back down. The Houthis attacked two Saudi ships, it goes back up. By the way, attacked. They didn't sink them, they didn't board them, they just made them turn away for the moment. They will pay a price for that, and so will a lot of innocent civilians that support the Houthis, but they will pay a price for that. But they didn't sink anything. They didn't, the fact is, they caused very little damage, but that causes a spike.
Right.
So, my thought this, Brian, I want to understand this is that what we've been seeing with natural gas, and I think what we've been seeing with crude, is what I call the higher for longer theory. And that is why we're not seeing these huge spikes, we're not seeing the huge lows.
Okay.
And so, what we might see for the market is that this may stay higher for longer. It may not be at 150, but it may be at 87, it may be at 92 for much longer than what people are thinking on, and then much longer than what the financial traders are actually
Mm.
trading on.
Hmm. Yeah, I
And
could
so I
see
was
that.
asking you, so I mean, I was thinking about this, guys. I do all my great thinking when I'm mowing the lawn. So I was thinking about this this weekend when I was mowing the lawn, and I think that this this may be what we're setting into a trap. Still see the spikes, but I think we'll see them moving up the scale on the trend line.
You know,
And so,
one thing on that I like to look at is I look at previous spikes, because you can identify previous spikes. And to your point, I think about it in terms of the financial impact and where we exist inside of Energy Rogue. Well, let me ask you, you were talking about a question. What was the core of your
so my
question? That was
question
a
is,
long, that
am
was
I
a long one.
that was the explanation is, do you think I'm seeing this correctly, or do you think that there's, you know, it's not a matter of whether financial fundamentals rule. It's a matter of which one's right at the right time. And
Yeah.
and so
And let's
what I'm seeing is, and I'm talking a probably 9 to 18 month window forward.
okay. A 9 to 18 month. I will say during the 9 to 18 month. Well, let me answer your question short, and then we'll go long. So the short answer is I do think you're right. We will be higher for longer, for a slightly different reason. In that I I think about things in financial terms, but I've always measured physical supply, demand, storage above where the financial technicals are, because I'm looking at a longer window. In other words, I think about it this way: the fundamentals, the supply and demand, that can be dislocated in the short term due to technicals or due to financial rigor,
Right.
financial trading. And the
That goes back to
absolute
my burnt toast theory. Right.
exactly. And so anything that is short lived, and it's part of the reason we established Energy Rogue, so that people can look beneath the headline. Because let's be clear, we went up massively. Brent went over 100, first time since early in the war. Brent went over 100 because the Houthis attacked the two vessels that you talked about. Headline,
Right.
headline response. and the response was up. Then Friday, it dropped. And then Monday, it opened Sunday night, but Monday, it further dropped. And the reason why? Red Sea flows were not disrupted. And that was the key disruption change that we were looking at was, is this going to impact physical? Now, I will look at it in two lenses. Us dropping after seeing Red Sea flows not being disrupted after that, that's the right move. However, I don't think we were at the right scale. This is where I get into a fundamental value. I think our fundamental value is broken right now. Let's go back in time before 2022, before the Russian invasion of Ukraine, that threw crude oil up. And then here we are years later, 4 years later, 4.5 almost years later, and crude oil traders are kind of tired. Show me the disruption and I'll respond. Because one of the keys is prior to the US and Iran war, prior to this, if we had 1,000,000 barrels a day of supply disruption, well, prior to that and the Russian-Ukraine war, but that has had less of a supply impact. But prior to this, 1,000,000 barrels a day of supply would move us $10, maybe even more.
Right.
Now we see 1,000,000 barrels a day, and traders are like, I'll move a couple dollars. So the big unwind that we're seeing is financials moving in and out at scale, and that is whipsawing everything because fundamentally WTI should probably be 120 and Brent should probably be 140. With this type of supply disruption, and we're not going to be back online anytime soon, my opinion is we're way undervalued in a physical sense. But I will say that doesn't mean the market's going to go there. We're not financial advisors, not trading advice, read the
Right.
disclaimers. But it means that that's where the physical gets to it. And we often see this, and it's part of the reason we created Energy Rogue. There's a disconnect between physical and financial. Sometimes one is in control of the other. And right now, I think the financial is in control of it because of currency, governments. The US Treasury is playing in this. So
So that's why I was saying.
that's my answer. That's my yes no answer for you.
So that's why I was saying higher for longer, because while I think that they're running the spikes, they're
Mhm.
we're seeing the fundamentals push it up from the bottom.
Yeah, I can see that.
So I mean, when I was doing the hedging for the producer, my deal was always you sell the hype. This is from a producer perspective. You sell the hype and you buy the fact.
Right. Right. Yeah.
You know.
Yeah. Well, it's part of the reason that again, we try and take a look at what is happening under the hood because if you break the market apart, okay, let's put it this way. If you have 10 apples, if you grow 10 apples and there's 10 people that want an apple apiece, that's great. Well, what if somebody watches those 10 and says, "Ooh, I want an apple," and half of them have friends that are, "Ooh, I want an apple." Now all of a sudden there's 15. Well, the price theoretically of apples will go up because there's more demand than supply. And conversely, when you have 10 apples, but everybody, they talked about a new diet that is oranges. Apples are bad for you. Pick oranges. Only eat oranges. An orange a day will keep the doctor away. It's not an apple anymore. Then you will have a drop in demand, so you'll have too much supply, and theoretically price goes down. Theoretically, because there's two markets happening at the same time. Because when we talk about price, we're normally talking about the financial contract, which is the financial observational market price
Right.
of crude oil. That is not the physical price. The physical price is transacted between individual companies or countries
Right.
and those prices aren't published. As a matter of fact, organizations such as Platts, Argus, Bloomberg, they post estimates based upon some data. And there
Right.
is
Now,
some data.
some refineries do a posted price, but the actual price paid is based on that posted price. It's not the actual posted price.
Well, that's like saying to the car dealership, what's
Oh
the
yeah,
price of the car? Well, that doesn't mean that that's the value of that
yeah.
car.
Here,
You
so that's a
know,
sticker price.
sticker price versus what you pay. It's what the refiner says that's going to be the market, and that's where we get into.
So I think the way you look at this is that when you buy financially and when you buy physically, you take title to something.
Mhm,
When you buy physically, you take title to the actual crude oil.
mhm.
When you buy financially, you take title to a contract on the NYMEX
Yes,
or an over the counter contract. It is not an actual. It's an actual thing. It's not an actual commodity,
right.
and so it's based on a commodity.
Yeah,
And so that's why you see the difference. So the what financial came in to do is because people would not give producers a long-term price for their commodity because they weren't sure what the real price was going to be. So
right.
the financial market comes in and provides that long-term liquidity for a future price. That's why we call them futures. It's for a future price. And so the producer is able to basically hedge their cash flow for that commodity. They still have to sell the physical commodity, but they've hedged it and then they swap those prices from physical to financial.
Yeah.
That's what that's what we're seeing doing. But I really think that we may be at a higher for longer period. We're still going to see some of that volatility, the headline volatility, escalation, price goes up, piece price goes down. That's just how it works.
So what we're really talking about is into the future. You have different prices, and this is one of our charts inside of Rogue Edge, where we look at the future out to what is that, 5 or 6 years, out to 2031. So right now, crude is trading for the balance of 2026 at 83, call it 84, but 2031, 5 years from now, you're $20 lower. Theoretically, that's what the financial market thinks. And then each month, look at this right here, but the futures contract is saying in December that we're already below $70. So this is what we look at every single day, and it's part of the reason that we create and that we evaluate the current market, what is happening, and we take a look at all the technicals. This is inside of Rogue Radar. And if you're interested, there's a 14-day free trial down below. And then we provide like an 8 or 9 page report twice a
Right.
week. And
So
this report really dives into three things: supply, demand, stocks, in addition to the financial side. We observe what's happening in the financial side, but we cross section that with the supply, demand, and storage and stocks.
So, folks, I just wanted to give you a little inside look of the conversations that Brian and I have every day. And
Right.
we're doing real good before he went all salesy. But so,
No, that's it. I'm done. Like, well, it's mainly there's so much depth and so many layers to each component that when we get into sales, it's really not one number on supply. It's a
no.
myriad of like 20 different variables inside the supply that help you triangulate direction. And because it's not only supply today, but it's supply tomorrow. And that's part of the reason we crystallize this into a report so that it can be observed and understood within 5 minutes. And that's what we do every single day so that you're equipped and you can understand what the future may hold. And it's part of the reason we come up with every week a base case of what we expect on price, a bull case of what could happen, a bear case of what could happen, and a wild card. And those are objective observations of what could happen. For example, I was putting it together today, and I noticed that my personal sentiment was in the bull case. It wasn't in the base case. It was in the bull case. I'm like, nope, we're going to be in the bull case. And that's what we try and take a look at, because when you're evaluating price and direction, you're predicting the future and you're going to be wrong a lot. And you need to understand, if you think prices will move up, understand your thesis as to why, but also understand your thesis as to what could go wrong. Because if you're not
Right.
doing that, you're not evaluating your risk. And
But you
that's
also
a,
you have to look at it in perspective of your exact situation,
yeah,
because everybody's not going to be in the same situation.
yeah.
So I think we sort of gave you a little bit of the insight. Next time you're out mowing the lawn and you have a question like that, man, feel free to give us a call or email, and we'll be more happy to talk about it, because there's a lot to this. It's not, I tell people it's not hard, but it is complex.
Yeah, yeah.
And so we've been more than happy to share with that with you. So that was my thought for the day.
Nope, I think that's a great thought. And listen, this is a good place to pause it, because we're really talking about the difference between headline fundamentals and looking beneath the surface to actually come up with what you believe to be objective reality into the future. And that is important. So listen, I'm Brian. This guy, nope, I always do it wrong. This guy,
There you
not
go.
this guy, not
I
this
keep moving
guy,
on you.
this guy. We got to do the Brady Bunch thing sometime,
Yeah,
you
exactly.
know.
There we go. And we need a few more people to do Brady Bunch.
That's true. That's true. So listen, folks, thanks so much. Really appreciate you stopping in. Drop us a comment down below. Let us know what you're thinking. And again, when you're looking at the market, don't look at just price. Look at supply, look at demand, and look at storage or stocks. Those
And
three
more
things.
importantly, look at Energy Rogue.
See, you were doing good till you get all salesy, man. I mean, come on, man. All right. So we will see you next week. Thanks for stopping in, and we'll talk soon.